Question 1. The audit findings indicate a pattern of minor policy violations related to data handling within the marketing department, specifically concerning the unauthorized sharing of client contact information with third-party vendors. Which of the following approaches best addresses this situation to ensure ongoing compliance and mitigate future risks? Option A. Escalate the issue to the Chief Executive Officer, recommending a complete overhaul of the company's data privacy policies and procedures across all departments, without first conducting a detailed investigation into the marketing department's specific issues. Option B. Focus solely on identifying and disciplining the individuals directly responsible for the policy violations within the marketing department to make an example and deter future misconduct. Option C. Conduct a thorough root cause analysis with the marketing department's management to identify training gaps, policy clarity issues, or resource constraints contributing to the violations, and collaboratively develop and implement targeted corrective actions, including enhanced training and policy reinforcement. Option D. Immediately issue a company-wide memorandum, reiterating the existing data handling policy and warning all employees of severe disciplinary action for any future violations. The correct answer is C. Conduct a thorough root cause analysis with the marketing department's management to identify training gaps, policy clarity issues, or resource constraints contributing to the violations, and collaboratively develop and implement targeted corrective actions, including enhanced training and policy reinforcement. Explanation. The audit findings indicate a recurring pattern of minor policy violations related to data handling within a specific department. This scenario is professionally challenging because it requires a compliance professional to move beyond simply identifying the problem to implementing sustainable solutions. The challenge lies in understanding the root cause of the violations, which may stem from inadequate training, unclear policies, insufficient resources, or a cultural issue within the department, rather than isolated individual misconduct. Careful judgment is required to balance enforcement with education and to ensure that corrective actions are proportionate and effective without unduly burdening the department or creating a climate of fear. The correct approach represents best professional practice because it focuses on a systematic root cause analysis and a multifaceted improvement strategy. This aligns with the principles of a robust compliance program, which emphasizes continuous improvement and proactive risk management. By involving the department's management in developing and implementing solutions, it fosters ownership and accountability, increasing the likelihood of long-term behavioral change. This approach also demonstrates a commitment to ethical conduct and regulatory adherence by addressing the underlying systemic issues that contribute to noncompliance, rather than just treating the symptoms. This proactive and collaborative method is essential for building a strong compliance culture and meeting the expectations of regulatory bodies that look for demonstrable efforts to prevent and detect violations. An incorrect approach that focuses solely on disciplinary action for the individuals involved fails to address the systemic issues. This is a regulatory and ethical failure because it neglects the organization's responsibility to provide adequate training and resources, and to establish clear, understandable policies. It treats compliance as a matter of individual fault rather than organizational responsibility, which is contrary to modern compliance program expectations. Such an approach can lead to a superficial fix, where violations may continue due to unaddressed root causes, and can damage employee morale and trust. Another incorrect approach that involves simply reissuing the existing policy without further explanation or training is also a regulatory and ethical failure. This demonstrates a lack of understanding of effective communication and training principles. A policy is only effective if it is understood and can be implemented. Merely reissuing it without addressing why violations are occurring or providing practical guidance is unlikely to change behavior and suggests a superficial commitment to compliance. It fails to meet the ethical obligation to ensure employees have the knowledge and tools to comply. A third incorrect approach that involves escalating the issue to senior management for a broad, company-wide policy overhaul without first conducting a targeted departmental investigation is also problematic. While senior management involvement is crucial, a premature escalation without a clear understanding of the specific departmental issues can lead to inefficient resource allocation and the implementation of unnecessary or overly burdensome controls across the entire organization. This approach risks overreacting to a localized problem and can be an ethical failure if it leads to the imposition of controls that are not proportionate to the actual risk identified. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly investigate the audit findings to understand the scope and nature of the violations. Second, conduct a root cause analysis to identify the underlying reasons for noncompliance. Third, collaborate with the affected department to develop tailored practical solutions that may include policy clarification, enhanced training, system improvements, or resource adjustments. Fourth, implement the agreed-upon solutions and establish metrics to monitor their effectiveness. Finally, report on the progress and outcomes to relevant stakeholders, including senior management, and be prepared to adjust the approach based on ongoing monitoring and feedback. This iterative process ensures that compliance efforts are targeted, effective, and sustainable. Question 2. Process analysis reveals that a company's internal audit department is considering its approach to fraud detection. The department is evaluating several strategies to identify potential financial misconduct within the organization. Which of the following approaches best aligns with best practices for a comprehensive fraud detection program under U.S. regulatory frameworks? Option A. Implementing a robust data analytics program to identify unusual transaction patterns and anomalies, complemented by a clear process for employees to report suspicious activities and red flags observed in their daily work. Option B. Focusing solely on developing advanced data analytics algorithms to detect deviations from expected financial behavior, assuming technology will catch all forms of fraud. Option C. Prioritizing the reduction of fraud detection expenses by limiting the scope of data analysis and the frequency of red flag investigations. Option D. Relying exclusively on employee tip lines and internal whistleblowing mechanisms to identify potential fraud, with no proactive data monitoring. The correct answer is A. Implementing a robust data analytics program to identify unusual transaction patterns and anomalies, complemented by a clear process for employees to report suspicious activities and red flags observed in their daily work. Explanation. This scenario presents a common challenge for compliance professionals, balancing the need for robust fraud detection with the practical constraints of resource allocation and the potential for over-reliance on single methods. The core difficulty lies in selecting the most effective and ethically sound approach to identify potential misconduct within a complex organization. A compliance professional must exercise careful judgment to ensure that the chosen methods are not only technically sound, but also align with regulatory expectations and ethical principles, avoiding both the risk of missing significant fraud and the inefficiency of excessive, unfocused scrutiny. The correct approach represents best professional practice because it advocates for a multi-layered strategy that leverages both proactive data analytics and reactive red flag identification. This aligns with the principles of a comprehensive compliance program, which requires continuous monitoring and a variety of controls to detect and prevent misconduct. Regulatory frameworks, such as those overseen by the U.S. Securities and Exchange Commission, SEC, and the Department of Justice, DOJ, in the context of the Foreign Corrupt Practices Act, FCPA, or the Sarbanes-Oxley Act, SOX, emphasize the importance of a risk-based approach to compliance, which includes effective internal controls and monitoring systems designed to detect fraud. Relying on a combination of data analytics to identify anomalies and red flags to investigate suspicious patterns provides a more holistic and resilient fraud detection mechanism. This approach is ethically sound as it aims to protect the organization and its stakeholders from financial harm and reputational damage. An incorrect approach that solely relies on data analytics without considering human-driven red flags fails to acknowledge that sophisticated fraud can sometimes evade purely algorithmic detection. Data analytics, while powerful, can be limited by the data available and the algorithms used. It might miss qualitative indicators of fraud or new, emerging schemes not yet captured by historical data patterns. This could lead to regulatory scrutiny for an inadequate compliance program. Another incorrect approach that focuses exclusively on investigating reported red flags without proactive data analysis is also professionally unacceptable. This reactive stance means the organization is only addressing issues that have already surfaced, potentially allowing significant fraud to persist undetected for extended periods. This can result in substantial financial losses and severe penalties for failing to implement adequate preventative and detective controls, a key expectation under various U.S. federal laws. Finally, an approach that prioritizes cost reduction over the effectiveness of fraud detection mechanisms is ethically and regulatorily flawed. While efficiency is important, compromising the integrity of fraud detection to save money can lead to greater long-term costs due to undetected fraud, fines, and reputational damage. This demonstrates a failure to uphold the duty of care and a disregard for the organization's ethical obligations and legal requirements. The professional decision-making process for similar situations should involve a thorough risk assessment to identify the most vulnerable areas for fraud. This assessment should then inform the selection and integration of multiple fraud detection techniques, including both technological solutions like data analytics and human-centric approaches like training employees to recognize and report red flags. Regular evaluation and adaptation of these techniques are crucial to maintain their effectiveness against evolving fraud schemes. The compliance professional must advocate for sufficient resources to implement and maintain these robust controls, ensuring that the program is both comprehensive and cost-effective in the long run. Question 3. Regulatory review indicates that a financial institution's anti-money laundering AML program has identified several areas for improvement, including outdated training materials, a lack of documented procedures for certain transaction monitoring alerts, and a recent independent testing report that highlighted potential gaps in the risk assessment methodology. The compliance officer is tasked with determining the most appropriate course of action to ensure the AML program remains effective and compliant with the Bank Secrecy Act, BSA, and its implementing regulations. Which of the following actions best addresses these identified deficiencies? Option A. Initiate a comprehensive review and enhancement of all core AML program components, including policies and procedures, training, and independent testing, to address the identified gaps and align with current regulatory expectations. Option B. Defer any significant program changes until the Financial Crimes Enforcement Network, FinCEN, issues specific guidance on the identified areas of concern. Option C. Focus solely on updating the AML training materials to reflect the latest suspicious activity typologies, as this is often the most visible component of the AML program. Option D. Prioritize conducting a new, more in-depth independent testing of the AML program to validate the findings of the previous report and identify any further issues. The correct answer is A. Initiate a comprehensive review and enhancement of all core AML program components, including policies and procedures, training, and independent testing, to address the identified gaps and align with current regulatory expectations. Explanation. This scenario presents a common challenge in compliance, balancing the need for robust AML program components with the practical realities of resource allocation and operational efficiency. The compliance officer must make a judgment call on the adequacy of the existing AML program in light of new regulatory expectations and internal findings. This requires a deep understanding of the Bank Secrecy Act, BSA, and its implementing regulations, particularly the requirements for an effective AML program, which include policies and procedures, training, and independent testing. The challenge lies in determining whether the identified gaps are minor oversights or systemic weaknesses that could expose the institution to significant legal and reputational risk. The correct approach demonstrates best professional practice by prioritizing a comprehensive and proactive response to identified deficiencies. It acknowledges that regulatory expectations evolve, and that internal testing is a critical mechanism for identifying and rectifying weaknesses before they are discovered by regulators. This approach aligns with the spirit and letter of the BSA, which mandates an effective AML program designed to prevent, detect, and report suspicious activity. By initiating a review and enhancement of all core AML program components, the compliance officer ensures that the program remains current, effective, and compliant with all applicable laws and guidance. This proactive stance is ethically sound and professionally responsible, safeguarding the institution and its stakeholders. An incorrect approach that focuses solely on the training component fails to address potential systemic issues within the policies and procedures or the independent testing methodology itself. This could lead to a situation where training is updated, but the underlying weaknesses in other program areas persist, rendering the training ineffective. This represents a regulatory failure to implement a comprehensive AML program as required by the BSA. Another incorrect approach that prioritizes only the independent testing, without a corresponding review of policies, procedures, and training, is also deficient. While testing is crucial, it is only one part of the AML program. Without updating the foundational elements, the testing may simply confirm existing weaknesses without leading to their resolution. This also constitutes a regulatory failure to maintain an effective AML program. A third incorrect approach that suggests waiting for explicit regulatory guidance before making changes is professionally negligent. Compliance professionals are expected to be forward-thinking and to anticipate regulatory trends and expectations. Relying solely on explicit directives can lead to a reactive posture, increasing the risk of non-compliance and penalties. This demonstrates a failure to exercise due diligence and a lack of proactive risk management, which are core ethical and professional obligations. The professional reasoning framework for this situation involves a risk-based approach. The compliance officer should first assess the severity and scope of the identified deficiencies. Then, they should consider the potential impact on the institution's ability to comply with AML regulations. Based on this assessment, they should prioritize actions to address the most critical gaps first, while also planning for a comprehensive review and enhancement of all AML program components to ensure ongoing effectiveness and compliance. This involves a continuous cycle of assessment, implementation, and monitoring. Question 4. Strategic planning requires a comprehensive approach to establishing and maintaining an effective whistleblower program. Considering the regulatory landscape for compliance professionals, which of the following best optimizes the process for encouraging reporting and ensuring appropriate action? Option A. Implement a multi-channel reporting system that includes both internal and external options, ensures strict confidentiality and non-retaliation, and mandates prompt, thorough, and impartial investigations with documented outcomes. Option B. Create a whistleblower policy that outlines the reporting process, but relies on employees independently seeking out information on their rights and protections. Option C. Establish a single, internal reporting hotline managed by the legal department, with a policy stating that all reports will be investigated as resources permit. Option D. Develop a system where all reports are immediately escalated to senior management for review before any investigation begins, with a focus on resolving issues quickly to minimize disruption. The correct answer is A. Implement a multi-channel reporting system that includes both internal and external options, ensures strict confidentiality and non-retaliation, and mandates prompt, thorough, and impartial investigations with documented outcomes. Explanation. This scenario is professionally challenging because it requires balancing the need for robust whistleblower protections with the practicalities of an effective reporting system, all within the specific regulatory framework of the Certified Compliance and Ethics Professional (CCEP) exam, which implies U.S. federal regulations. The CCEP designation, particularly when focused on U.S. regulations, emphasizes adherence to laws like the Sarbanes-Oxley Act (SOX) and the Dodd-Frank Act, which provides significant protections and mandates for whistleblower programs. The correct approach represents best professional practice because it directly addresses the core requirements of whistleblower legislation by establishing multiple, accessible reporting channels and ensuring prompt, thorough, and confidential investigations. This aligns with the intent of SOX and Dodd-Frank to encourage reporting of potential misconduct without fear of retaliation. Confidentiality and non-retaliation are paramount ethical and legal obligations. An incorrect approach that focuses solely on a single, internal reporting channel fails to meet the spirit and letter of regulations that often encourage or mandate diverse reporting options, including external ones, to ensure effectiveness. This could lead to a perception that the company is not genuinely committed to uncovering wrongdoing. Another incorrect approach that prioritizes speed over thoroughness in investigations risks overlooking critical details, potentially leading to incomplete findings, missed violations, or even wrongful accusations. This undermines the integrity of the program and could expose the organization to legal and reputational damage. A third incorrect approach that fails to adequately train employees on reporting procedures and protections creates a knowledge gap, making the program ineffective. Employees may be unaware of how to report, what protections they have, or even that such a program exists, thereby stifling legitimate reports. Professionals should employ a decision-making framework that begins with a thorough understanding of applicable regulations, e.g., SOX, Dodd-Frank. This involves identifying mandated reporting mechanisms, protection requirements, and investigation standards. The next step is to design a program that not only meets these minimum requirements, but also fosters a culture of trust and transparency. This includes offering multiple, accessible reporting avenues, ensuring robust confidentiality and non-retaliation policies are communicated and enforced, and establishing clear, well-resourced investigation protocols. Regular training and program review are essential to ensure ongoing effectiveness and compliance. Question 5. The performance metrics show a significant increase in new account openings over the past quarter, exceeding targets by 15%. During a review of recent onboarding, the compliance officer noted that while transaction volumes for several new clients are moderate, their business activities involve operating in industries identified as higher risk for money laundering, and their beneficial ownership structures are complex. The business development team is pushing to expedite onboarding for all new clients to maintain momentum. The compliance officer is considering how to proceed with due diligence for these specific clients. Which of the following actions best reflects a risk-based approach to customer due diligence, CDD, and enhanced due diligence, ED, in this scenario, adhering to U.S. regulatory frameworks? Option A. Prove the onboarding of these clients under standard CDD procedures, as their current transaction volumes do not meet the predefined threshold for EDD, and focus EDD efforts on clients with exceptionally high transaction activity. Option B. Escalate the decision for EDD to the business development team lead, allowing them to determine if the potential revenue justifies the additional due diligence burden. Option C. Apply EDD to all new clients opened during this quarter to ensure a consistent and thorough review, given the accelerated onboarding pace. Option D. Initiate enhanced due diligence, ED, for these clients due to the identified high-risk industries and complex beneficial ownership structures, irrespective of current transaction volumes, and communicate the rationale to the business development team. The correct answer is D. Initiate enhanced due diligence, ED, for these clients due to the identified high-risk industries and complex beneficial ownership structures, irrespective of current transaction volumes, and communicate the rationale to the business development team. Explanation. This scenario presents a professional challenge due to the inherent tension between efficient client onboarding and robust compliance with customer due diligence, CDD, and enhanced due diligence, ED, requirements. The compliance officer must balance the need to facilitate business growth with the imperative to mitigate risks associated with money laundering, terrorist financing, and other financial crimes. The pressure to meet performance metrics can create an environment where shortcuts are tempting, but adherence to regulatory frameworks is paramount. Careful judgment is required to identify when standard CDD is insufficient and EDD is necessary, without unduly hindering legitimate customer relationships. The correct approach represents best professional practice because it prioritizes a risk-based assessment of customer relationships. This aligns directly with the principles of the Bank Secrecy Act, BSA, and its implementing regulations, such as the Customer Identification Program, CIP, rules and the CDD Rule, 31 CFR Section 1010. 230. By escalating for EDD based on objective risk indicators, the compliance officer is fulfilling their regulatory obligation to understand the nature and purpose of customer relationships and to conduct ongoing monitoring. This proactive stance is crucial for identifying and reporting suspicious activity, thereby protecting the financial institution and the broader financial system. Ethically, it demonstrates a commitment to integrity and responsible business conduct. An incorrect approach that relies solely on the volume of transactions for EDD triggers fails to consider the full spectrum of risk factors. Regulatory frameworks emphasize a holistic risk assessment that includes, but is not limited to, transaction volume. For example, a customer with low transaction volume but operating in a high-risk industry or jurisdiction would warrant EDD. This approach also risks creating a false sense of security by overlooking other significant risk indicators. Another incorrect approach that defers EDD decisions solely to the business line without independent compliance oversight is a significant regulatory and ethical failure. Business lines are primarily focused on revenue generation and may not possess the specialized knowledge or impartiality required to accurately assess complex risks. This abdication of responsibility undermines the independence of the compliance function, a core tenet of effective compliance programs. It also violates the principle of a strong tone at the top and a culture of compliance. Third incorrect approach that applies EDD uniformly to all new clients, regardless of risk, is inefficient and counterproductive. While it might appear to be a conservative measure, it can lead to unnecessary burdens on both the institution and legitimate customers, potentially driving away business. Effective compliance is risk-based, meaning resources are focused where the risk is greatest. This approach fails to demonstrate proportionality and efficient resource allocation. The professional decision-making process for similar situations should involve a thorough understanding of the institution's risk assessment framework, which should be aligned with regulatory expectations. This includes identifying and evaluating risk factors related to customer type, geographic location, products and services, and transaction patterns. When red flags or elevated risk indicators are identified, the compliance officer must have clear procedures for escalating the matter for EDD. This process should involve collaboration between compliance and business lines, but with compliance retaining the ultimate authority for risk assessment and decision-making regarding EDD. Regular training and updates on evolving risks and regulatory requirements are also essential. Question 6. Implementation of a comprehensive anti-fraud program within a financial services firm requires a multifaceted approach, considering the potential for sophisticated schemes like Ponzi schemes. Which of the following best reflects a best practice for a compliance professional in preventing and detecting such fraud? Option A. Establishing clear policies and procedures for financial transactions, conducting thorough due diligence on all counterparties and investments, and implementing ongoing monitoring of financial activities for unusual patterns. Option B. Waiting for significant financial losses to occur before initiating an internal investigation into potential fraudulent activities. Option C. Delegating all responsibility for fraud detection and prevention exclusively to external auditors, without establishing internal oversight or reporting mechanisms. Option D. Relying solely on the absence of explicit warnings or complaints from external parties as an indicator of the legitimacy of all financial dealings. The correct answer is A. Establishing clear policies and procedures for financial transactions, conducting thorough due diligence on all counterparties and investments, and implementing ongoing monitoring of financial activities for unusual patterns. Explanation. This scenario presents a professional challenge due to the inherent difficulty in detecting sophisticated fraud schemes like Ponzi schemes, which often rely on deception and a veneer of legitimacy. Compliance professional must balance the need for robust oversight with the practical realities of business operations, ensuring that preventative measures are effective without unduly hindering legitimate activities. The core of the challenge lies in identifying subtle indicators of fraud and acting decisively based on incomplete information, while adhering to regulatory expectations for due diligence and risk management. The correct approach represents best professional practice because it prioritizes a proactive, risk-based strategy that integrates multiple layers of defense. This includes establishing clear policies, conducting thorough due diligence on all parties involved in financial transactions, and implementing ongoing monitoring mechanisms. Such an approach aligns with regulatory frameworks that mandate a strong internal control environment and a commitment to preventing financial misconduct. By focusing on the substance of transactions and the reputation of counterparties, the compliance professional demonstrates a commitment to ethical conduct and regulatory compliance, thereby safeguarding the organization from financial losses and reputational damage. An incorrect approach that relies solely on the absence of explicit red flags or assumes the legitimacy of all transactions based on superficial documentation fails to meet the standard of professional care expected of a compliance officer. This approach exhibits a critical regulatory failure by neglecting the duty to conduct adequate due diligence and to implement effective anti-fraud controls. Ethically, it represents a dereliction of duty, as it prioritizes convenience over the responsibility to protect the organization and its stakeholders from fraudulent activities. Another incorrect approach that involves reacting only after a significant loss has occurred demonstrates a reactive rather than a proactive stance. This is a significant regulatory failure, as it indicates a lack of foresight and an inadequate risk assessment process. Ethically, it suggests a failure to uphold the principle of safeguarding the organization's assets and reputation, as preventative measures were not sufficiently robust. A third incorrect approach that involves delegating all fraud detection responsibilities to external auditors without establishing internal oversight mechanisms is also professionally unacceptable. While external audits are valuable, they are not a substitute for a strong internal compliance program. This approach represents a regulatory failure by not establishing a comprehensive internal control system, and an ethical failure by abdicating a core responsibility of the compliance function. The professional decision-making process for similar situations should involve a systematic risk assessment, the development and implementation of clear policies and procedures, ongoing training for relevant personnel, and the establishment of robust monitoring and reporting mechanisms. Compliance professionals must cultivate a skeptical mindset, be aware of common fraud schemes, and continuously evaluate the effectiveness of their controls. When red flags are identified, a thorough investigation should be initiated, documented, and escalated appropriately, always in accordance with established protocols and regulatory requirements. Question 7. Governance review demonstrates a potential systemic issue within the retail lending division concerning the consistent application of fair lending policies, as evidenced by a preliminary analysis of loan approval data. The compliance officer must determine the appropriate next steps to address this potential regulatory exposure. Option A. Initiate an immediate, comprehensive internal audit of the retail lending division's entire loan origination process, suspending all new loan approvals in that division until the audit is complete. Option B. Immediately escalate the preliminary findings to the Board of Directors and the relevant federal banking regulators, recommending a moratorium on all retail lending activities. Option C. Request the retail lending division manager to conduct their own internal review and provide a report on the findings and proposed corrective actions within 30 days. Option D. Conduct a targeted, in-depth investigation into the specific loan segments and data points that triggered the initial concern, gathering further evidence and consulting with legal counsel before determining the scope of any necessary remediation. The correct answer is A. Initiate an immediate, comprehensive internal audit of the retail lending division's entire loan origination process, suspending all new loan approvals in that division until the audit is complete. Explanation. Scenario analysis. This scenario presents a challenge because the compliance officer must balance the immediate need to address a potential regulatory breach with the operational realities of a business unit. The pressure to maintain business continuity and revenue streams can conflict with the imperative to halt potentially non-compliant activities. The compliance officer needs to exercise sound judgment, understanding the nuances of the identified risk and the potential consequences of both inaction and overly aggressive action. The challenge lies in determining the appropriate level of intervention without causing undue disruption or failing in their regulatory oversight duties. Correct approach analysis. The correct approach demonstrates best professional practice by prioritizing a thorough, risk-based investigation before implementing drastic measures. This aligns with the principles of effective compliance programs, which emphasize understanding the nature and scope of potential violations. By gathering sufficient information, the compliance officer can accurately assess the severity of the issue, identify root causes, and develop targeted remediation. This approach respects due process for the business unit, while fulfilling the compliance function's obligation to ensure adherence to banking regulations, such as those promulgated by the Federal Reserve and OCC, which mandate robust risk management and internal controls. Incorrect approaches analysis. One incorrect approach fails by immediately imposing a blanket halt on all related transactions without a complete understanding of the situation. This is a regulatory failure because it bypasses the necessary investigative steps required to confirm a violation and its scope, potentially leading to unnecessary business disruption and reputational damage. Ethically, it demonstrates a lack of due diligence and fairness to the business unit. Another incorrect approach is to defer the decision entirely to the business unit's management without independent verification. This represents a significant failure in the compliance function's oversight responsibilities. Banking regulations, particularly those from the FDIC, OCC, and Federal Reserve, require an independent compliance function to identify and address risks. Abdicating this responsibility to the business unit creates a conflict of interest and a severe compliance gap, as the business unit may not have the expertise or incentive to identify or report all potential issues. A third incorrect approach involves implementing minor, superficial controls without a deep dive into the root cause. This is a compliance failure because it addresses symptoms rather than the underlying problem, leaving the institution vulnerable to future, potentially more severe, violations. Banking regulations demand effective controls that address identified risks comprehensively. This approach also risks misleading senior management and regulators about the true state of compliance. Professional reasoning. Professionals facing similar situations should employ a structured, risk-based decision-making process. This involves 1. Initial assessment. Quickly evaluate the reported issue for immediate red flags or systemic risk. 2. Information gathering. Conduct a focused, fact-finding investigation to understand the nature, scope, and potential impact of the issue. 3. Risk evaluation. Assess the severity of the potential violation against relevant regulatory requirements and internal policies. 4. Stakeholder consultation. Engage with relevant business units and legal counsel to gather perspectives and inform the decision. 5. Action planning. Develop a proportionate and effective remediation plan, which may range from enhanced monitoring to immediate operational changes based on the investigation's findings. 6. Documentation and reporting. Maintain thorough records of the investigation, decision-making process, and actions taken, and report findings to senior management and, if necessary, regulators. Question 8. Strategic planning requires a financial institution's compliance department to develop and implement robust anti-money laundering AML policies. Considering the guidance from the Financial Action Task Force (FATF) and the Wolfsburg Principles, which of the following approaches best aligns with international standards for managing the risks associated with customer due diligence (CDD) and enhanced due diligence (ED)? Option A. Apply the most stringent enhanced due diligence procedures to all customers and transactions, irrespective of their assessed risk profile, to ensure maximum compliance. Option B. Rely on the existing customer due diligence procedures without incorporating recent updates to FATF recommendations or Wolfsburg principles, assuming current controls are sufficient. Option C. Prioritize the speed of customer onboarding and transaction processing over the thoroughness of enhanced due diligence, particularly for customers identified as potentially high risk, to maintain business competitiveness. Option D. Implement a risk-based approach that categorizes customers and products based on inherent risk levels, applying enhanced due diligence measures proportionally to high-risk segments, and regularly updating policies based on evolving guidance. The correct answer is D. Implement a risk-based approach that categorizes customers and products based on inherent risk levels, applying enhanced due diligence measures proportionally to higher-risk segments, and regularly updating policies based on evolving guidance. Explanation. This scenario presents a professional challenge because it requires a compliance officer to balance the imperative of robust anti-money laundering (AML) controls with the practical realities of business operations and the evolving nature of international standards. The FATF recommendations and the Wolfsburg Principles, while not legally binding in themselves, represent global best practices that financial institutions are expected to adhere to, often codified into local regulations. The difficulty lies in interpreting and implementing these principles effectively, especially when dealing with diverse customer bases and cross-border transactions, without unduly hindering legitimate business. The correct approach represents best professional practice because it demonstrates a proactive and risk-based methodology. By conducting a thorough assessment of the inherent risks associated with different customer segments and product offerings, and then tailoring enhanced due diligence (ED) measures accordingly, the institution aligns its AML efforts with the FATF risk-based approach. This ensures that resources are focused where the risk is greatest, promoting efficiency and effectiveness. Furthermore, continuous monitoring and periodic review of EDD policies, informed by updates to FATF guidance and Wolfsburg principles, ensures that the program remains current and responsive to emerging threats, reflecting a commitment to ongoing compliance and ethical conduct. An incorrect approach that focuses solely on applying the most stringent EDD to all customers, regardless of risk, is professionally unacceptable. This approach fails to adhere to the risk-based principle, leading to inefficient allocation of resources and potentially alienating low-risk customers. It also deviates from the spirit of international standards, which advocate for proportionality. Another incorrect approach that relies on outdated EDD procedures, failing to incorporate recent FATF updates or Wolfsburg guidance, represents a significant regulatory and ethical failure. This demonstrates a lack of diligence and a failure to keep pace with evolving AML threats and best practices, increasing the institution's vulnerability to financial crime and reputational damage. A third incorrect approach that prioritizes business expediency over AML compliance by implementing superficial EDD for high-risk customers to avoid delays is a direct contravention of both regulatory requirements and ethical obligations. This approach exposes the institution to severe legal penalties, sanctions, and reputational harm, and undermines the integrity of the financial system. Professionals should adopt a decision-making framework that begins with understanding the specific regulatory obligations in their operating jurisdiction, which are often informed by FATF and Wolfsburg. This should be followed by a comprehensive risk assessment to identify high-risk areas. Based on this assessment, a risk-based AML program should be designed, incorporating appropriate customer due diligence, CDD, and EDD measures. Crucially, this program must include mechanisms for ongoing monitoring, regular review, and adaptation to new guidance and emerging risks, ensuring continuous improvement and adherence to both legal and ethical standards. Question 9. The evaluation methodology shows that the Compliance Department's current processes for monitoring employee adherence to the Code of Conduct are resource-intensive and could be streamlined. The Chief Compliance Officer, CCO, is considering implementing new technology and consolidating reporting structures to improve efficiency. Which of the following approaches best balances process optimization with the ethical and governance requirements of a robust compliance program? Option A. Bypass the standard corporate governance approval process for technology adoption and reporting structure changes, proceeding with the optimization based on the CCO's sole discretion to expedite the initiative. Option B. Implement new monitoring technology and consolidate reporting structures, ensuring that the optimization process includes a thorough review of potential ethical implications and maintains adequate oversight and accountability mechanisms, with input from relevant stakeholders and board oversight. Option C. Introduce new monitoring technology and consolidate reporting structures immediately to demonstrate rapid progress, deferring any detailed ethical or governance review until after the implementation is complete. Option D. Prioritize the fastest and most cost-effective method of streamlining the monitoring process, focusing solely on reducing operational expenses without extensive consultation or detailed risk assessment of the changes. The correct answer is B. Implement new monitoring technology and consolidate reporting structures, ensuring that the optimization process includes a thorough review of potential ethical implications and maintains adequate oversight and accountability mechanisms, with input from relevant stakeholders and board oversight. Explanation: this scenario is professionally challenging because it requires a compliance professional to balance the need for efficient process optimization with the fundamental ethical and governance principles that underpin a robust compliance program. The pressure to demonstrate tangible improvements can sometimes lead to shortcuts that compromise the integrity of the compliance function. Careful judgment is required to ensure that optimization efforts do not inadvertently weaken controls or create new ethical risks. The correct approach represents best professional practice because it prioritizes the integration of ethical considerations and governance principles into the optimization process itself. This ensures that efficiency gains are achieved without sacrificing the effectiveness of the compliance program. By involving key stakeholders and focusing on a holistic review, the compliance professional demonstrates a commitment to transparency, accountability, and the long-term sustainability of ethical conduct, aligning with the core tenets of corporate governance and professional ethics expected of a CCEP. This approach fosters a culture of compliance that is embedded within the organization's operations. An incorrect approach that focuses solely on cost reduction without considering the impact on compliance oversight would be ethically flawed. It risks undermining the very purpose of the compliance function, potentially leading to regulatory breaches and reputational damage. This approach fails to recognize that compliance is not merely a cost center to be minimized, but a critical component of responsible business conduct and risk management. Another incorrect approach that prioritizes speed of implementation over thorough risk assessment would be professionally unacceptable. This haste could overlook critical control gaps or introduce new vulnerabilities, thereby increasing the organization's exposure to noncompliance. It demonstrates a lack of due diligence and a failure to uphold the professional standard of care expected in compliance matters. A third incorrect approach that bypasses established governance protocols for decision-making, such as seeking approval from the board or relevant committees, would be a direct violation of corporate governance principles. This lack of transparency and adherence to established authority structures erodes trust and can lead to decisions that are not in the best interest of the organization or its stakeholders. The professional decision-making process for similar situations should involve a structured approach. First, clearly define the objectives of the optimization initiative, ensuring they align with both business goals and compliance requirements. Second, conduct a thorough risk assessment of proposed changes, considering potential ethical and regulatory implications. Third, engage relevant stakeholders, including legal, audit, and business unit leaders, to gather input and ensure buy-in. Fourth, document the decision-making process and the rationale for chosen approaches. Finally, establish metrics to monitor the effectiveness of the optimized processes and make adjustments as needed, always maintaining a commitment to ethical conduct and regulatory adherence. Question 10. Investigation of a proposed strategic investment by a publicly traded company reveals significant potential for market expansion and profitability. However, the investment also carries substantial environmental risks that could negatively impact a local community and the broader ecosystem. The board of directors is deliberating on whether to proceed with the investment. From a corporate governance and ethics perspective, stakeholder perspective should primarily guide the board's decision-making process to ensure responsible and sustainable corporate conduct. Option A. The long-term interests of all stakeholders, including shareholders, employees, customers, the environment, and the communities in which the company operates. Option B. The concerns and well-being of the local community directly affected by the environmental risks, as they bear the most immediate burden. Option C. The immediate financial returns and shareholder value maximization, as this is the primary fiduciary duty of the board. Option D. The interests of the company's employees, who would benefit from job creation and career advancement opportunities associated with the investment. The correct answer is A. The long-term interests of all stakeholders, including shareholders, employees, customers, the environment, and the communities in which the company operates. Explanation. This scenario presents a professional challenge because it requires balancing the fiduciary duties of the board with the diverse and sometimes conflicting interests of various stakeholders. The compliance and ethics professional must navigate the complexities of corporate governance principles, ensuring that the board's actions are not only legally compliant, but also ethically sound and aligned with long-term sustainability. The challenge lies in identifying the most appropriate stakeholder perspective to guide the board's decision-making process when faced with a strategic investment that has both significant potential benefits and considerable environmental risks. The correct approach, focusing on the long-term interests of all stakeholders, represents best professional practice because it aligns with modern corporate governance frameworks that emphasize sustainability and responsible business conduct. This perspective acknowledges that a company's success is intrinsically linked to its ability to manage its impact on society and the environment, thereby ensuring its continued viability and value creation for shareholders, employees, customers, and the wider community. This approach is supported by principles of good corporate citizenship and the growing expectation for companies to operate with a broader social license. An incorrect approach that prioritizes only short-term shareholder returns would represent a regulatory and ethical failure. This is because it neglects the board's broader fiduciary duties, which extend beyond maximizing immediate profits to include safeguarding the company's reputation, managing risks, including environmental and social risks, and ensuring long-term value creation. Such a narrow focus can lead to decisions that, while potentially profitable in the short term, could result in significant reputational damage, regulatory penalties, or operational disruptions due to unmanaged environmental impacts, ultimately harming all stakeholders, including shareholders, in the long run. Another incorrect approach that solely considers the interests of the local community affected by the environmental risks would also be professionally unacceptable. While community well-being is a crucial consideration, A board's responsibility is to the company as a whole and all its stakeholders. Ignoring the potential benefits of the investment for other stakeholders, such as job creation or technological advancement, would be an unbalanced and potentially detrimental approach. This could lead to missed opportunities and a failure to fulfill the board's duty to the company's overall success and sustainability. The professional decision-making process for similar situations should involve a comprehensive stakeholder analysis. This includes identifying all relevant stakeholders, understanding their interests and concerns, and assessing the potential impact of the decision on each group. The compliance and ethics professional should facilitate a process where the board considers these diverse perspectives, evaluates the risks and benefits through a long-term lens, and makes decisions that are ethically defensible, legally compliant, and strategically sound, thereby fostering trust and ensuring the company's sustainable success. Question 11. What factors determine the most appropriate risk assessment methodology for a U.S.-based financial institution seeking to enhance its anti-money laundering (AML) compliance program, considering the Bank Secrecy Act (BSA) and its implementing regulations? Option A. The methodology most frequently cited in academic research on AML risk assessment, regardless of its practical applicability to the institution's unique operational context. Option B. A methodology that prioritizes the lowest implementation cost, even if it offers a less comprehensive or granular assessment of potential AML risks. Option C. A methodology that is mandated for a different, albeit related, industry sector, assuming it provides a general framework for risk identification. Option D. The institution's specific business lines, customer base, geographic reach, and the inherent risks associated with its products and services, alongside the availability of internal resources and expertise to implement and maintain the chosen methodology. The correct answer is D. The institution's specific business lines, customer base, geographic reach, and the inherent risks associated with its products and services, alongside the availability of internal resources and expertise to implement and maintain the chosen methodology. Explanation. This scenario presents a common challenge for compliance and ethics professionals, selecting the most appropriate risk assessment methodology for a given organization. The challenge lies in the fact that no single methodology is universally superior. The effectiveness of a methodology is contingent upon the specific context of the organization, including its size, complexity, industry, regulatory environment, and risk appetite. Careful judgment is required to balance the need for thoroughness with practical considerations of resources and feasibility. The correct approach, which involves a comparative analysis of various methodologies against the organization's specific characteristics and objectives, represents best professional practice. This aligns with the principles of a robust compliance program, emphasizing a tailored and risk-based approach. Regulatory frameworks, such as those governing financial services or healthcare in the U.S., often mandate or strongly encourage a risk-based approach to compliance, requiring organizations to identify, assess, and mitigate risks effectively. Ethically, this approach demonstrates due diligence and a commitment to proactive risk management, safeguarding both the organization and its stakeholders. An incorrect approach that relies solely on a widely adopted but potentially ill-fitting methodology fails to adequately address the organization's unique risk profile. This can lead to misallocation of resources, overlooking critical risks, or overemphasizing minor ones, thereby failing to meet regulatory expectations for a risk-based program. For example, using a purely qualitative methodology in a highly regulated industry with complex financial transactions might not provide the necessary granularity to identify and quantify specific financial crime risks, potentially violating regulations that require detailed risk assessments. Another incorrect approach that focuses exclusively on the cost-effectiveness of a methodology, without considering its suitability or comprehensiveness, is also professionally unacceptable. Resource constraints are a reality. Prioritizing cost over effectiveness can result in a superficial risk assessment that fails to identify significant compliance or ethical vulnerabilities, leaving the organization exposed to regulatory sanctions, reputational damage, and financial losses. This could be seen as a failure to exercise professional skepticism and due care. A third incorrect approach that relies on a methodology solely because it is mandated by a specific, but not universally applicable, industry standard, without considering its fit for the organization's broader compliance and ethical landscape, is also flawed. While adherence to standards is important, a rigid application without contextualization can lead to a compliance program that is technically compliant in one area but deficient in others, failing to achieve the holistic risk management objective. The professional decision-making process for similar situations should involve 1. Understanding the organization's business objectives, operational structure, industry, and regulatory landscape. 2. Identifying the range of available risk assessment methodologies and their strengths and weaknesses. 3. Evaluating each methodology's suitability based on the organization's specific context, including its risk appetite, available resources, and the nature of the risks it faces. 4. Conducting a comparative analysis to determine which methodology or combination of methodologies will provide the most effective and efficient means of identifying, assessing, and prioritizing compliance and ethical risks. 5. Documenting the rationale for the chosen methodology and ensuring it is regularly reviewed and updated. Question 12. When evaluating a situation where a valued business partner has inadvertently violated a minor internal policy, and the compliance officer is under pressure from sales management to overlook the infraction to preserve the partnership, which ethical decision-making framework approach best upholds the organization's commitment to integrity and compliance? Option A. Prioritize a thorough fact-finding process. Consult the company's code of conduct and relevant policies, assess potential risks and consequences of all actions, and seek guidance from senior leadership or legal counsel to ensure the decision aligns with the organization's ethical standards and risk appetite. Option B. Delegate the decision to the sales manager, trusting their judgment on how best to manage the relationship with the business partner without further compliance involvement. Option C. Focus primarily on the immediate financial implications of reporting the violation versus overlooking it, making a decision based on the option that minimizes short-term financial disruption. Option D. Immediately dismiss the violation as a minor oversight given the partner's importance and the potential negative impact on sales, focusing solely on maintaining the business relationship. The correct answer is A. Prioritize a thorough fact-finding process, consult the company's code of conduct and relevant policies, assess potential risks and consequences of all actions, and seek guidance from senior leadership or legal counsel to ensure the decision aligns with the organization's ethical standards and risk appetite. Explanation. This scenario presents a common ethical dilemma where a compliance professional faces pressure to overlook a minor policy violation to maintain a positive relationship with a key business partner. The challenge lies in balancing the organization's commitment to its code of conduct and regulatory obligations with the immediate business imperative of preserving a valuable partnership. A rigid adherence to policy might jeopardize the relationship, while overlooking the violation could expose the organization to reputational damage, regulatory scrutiny, and a weakening of its ethical culture. Careful judgment is required to navigate these competing interests. The correct approach involves a systematic ethical decision-making framework that prioritizes the organization's integrity and compliance obligations. This approach would involve gathering all relevant facts, consulting the company's code of conduct and relevant policies, and considering the potential consequences of both action and inaction. It would also involve seeking guidance from legal counsel or senior management to ensure a decision aligns with the organization's risk appetite and ethical standards. This method represents best professional practice because it demonstrates a commitment to upholding ethical principles and regulatory requirements, thereby safeguarding the organization's long-term reputation and legal standing. It fosters a culture of accountability and reinforces that ethical conduct is non-negotiable, even when faced with business pressures. An incorrect approach would be to immediately dismiss the violation due to the partner's importance. This fails to acknowledge the potential systemic risks associated with even minor breaches and undermines the integrity of the compliance program. It suggests that business relationships can override ethical obligations, creating a dangerous precedent. Another incorrect approach would be to focus solely on the financial impact of reporting the violation, ignoring the ethical and reputational dimensions. This utilitarian calculation, while seemingly pragmatic, can lead to decisions that are ethically unsound and may result in greater long-term harm. A third incorrect approach would be to delegate the decision to a subordinate without providing clear ethical guidance, abdicating responsibility, and potentially leading to inconsistent or inappropriate outcomes. This demonstrates a lack of leadership in ethical matters and fails to foster a strong ethical culture. Professionals should employ a structured ethical decision-making process. This typically involves 1. Identifying the ethical issue and relevant facts. 2. Consulting applicable codes of conduct, policies, and regulations. 3. Identifying stakeholders and their interests. 4. Evaluating alternative courses of action and their potential consequences. 5. Seeking advice from trusted colleagues, mentors, or legal counsel. 6. Making a reasoned decision and implementing it. 7. Reflecting on the outcome and lessons learned. This systematic approach ensures that decisions are well considered, defensible, and aligned with ethical and legal standards. Question 13. The assessment process reveals that a significant new regulatory framework governing data privacy has been enacted, requiring substantial changes to how customer information is collected, stored, and processed. The Chief Operating Officer is concerned about the immediate impact on marketing campaigns and customer service workflows, suggesting a focus on minimal, immediate adjustments to avoid operational disruption and associated costs. As the certified compliance and ethics professional, what is the most appropriate best practice evaluation of how to proceed? Option A. Prioritize immediate, superficial adjustments to data handling processes that address the most obvious requirements of the new framework, deferring deeper integration until the framework's enforcement mechanisms become clearer. Option B. Engage external legal counsel and consultants to draft new policies and procedures, assuming they possess the most up-to-date knowledge of the regulatory requirements and their implications. Option C. Focus solely on updating customer-facing communication material to reflect the new privacy standards, while leaving internal data handling processes largely unchanged until specific enforcement actions necessitate a response. Option D. Conduct a comprehensive, cross-functional impact assessment to understand the full scope of changes required across all business operations. Develop a phased implementation plan with clear ownership and timelines, and integrate new policies and training into existing operational procedures. The correct answer is D. Conduct a comprehensive, cross-functional impact assessment to understand the full scope of changes required across all business operations. Develop a phased implementation plan with clear ownership and timelines, and integrate new policies and training into existing operational procedures. Explanation. This scenario is professionally challenging because it requires a compliance professional to balance the immediate operational needs of the business with the long-term implications of adapting to new regulatory requirements. The pressure to maintain business continuity and profitability can lead to shortcuts or a reactive rather than proactive approach. Careful judgment is required to ensure that the business not only complies with the letter of the law, but also upholds the spirit of the regulation and ethical standards. The correct approach represents best professional practice because it prioritizes a thorough understanding of the regulatory change and its potential impact across all business functions. This proactive, systematic evaluation allows for the development of comprehensive and integrated solutions that minimize disruption and ensure sustained compliance. It aligns with ethical obligations to act with due diligence and to safeguard the integrity of the organization's compliance program. This approach fosters a culture of compliance by embedding regulatory awareness into strategic planning and operational processes. An incorrect approach that focuses solely on immediate cost-cutting without a full impact assessment risks superficial compliance. This could lead to the business failing to address the root causes of non-compliance or overlooking critical operational adjustments, thereby exposing the organization to significant regulatory penalties, reputational damage, and potential legal action. Ethically, this approach demonstrates a lack of commitment to robust compliance and a disregard for the potential harm to stakeholders. Another incorrect approach that relies on external consultants without internal validation or knowledge transfer creates dependency and may not fully integrate the new requirements into the organization's unique operational context. This can result in a compliance program that is not sustainable or adaptable to future changes. It also fails to build internal capacity and understanding, which is crucial for long-term ethical and regulatory adherence. A third, incorrect approach that delays implementation until enforcement action is imminent is a clear failure of proactive compliance and ethical responsibility. This reactive stance not only increases the likelihood of violations, but also signals a disregard for regulatory obligations and a lack of commitment to ethical business conduct. It exposes the organization to the highest risk of severe penalties and reputational damage. Professionals should use a decision-making framework that begins with identifying and understanding the regulatory change. This should be followed by a comprehensive impact assessment across all relevant business units and processes. Based on this assessment, a strategic plan for implementation should be developed, including resource allocation, training, and policy updates. Continuous monitoring and review are essential to ensure ongoing effectiveness and to adapt to any further regulatory developments or interpretations. This systematic process ensures that compliance is integrated into the business strategy rather than being an afterthought. Question 14. The risk matrix shows a high likelihood and high impact rating for third-party vendor due diligence failures. The compliance team has identified this as a critical area requiring immediate attention. Which of the following actions represents the most effective and compliant response to this identified risk? Option A. Develop and implement a new, detailed vendor due diligence policy and procedure, including enhanced screening criteria, ongoing monitoring protocols, and clear escalation paths for identified issues, with assigned responsibilities and a phased implementation timeline. Option B. Increase the frequency of general compliance training for all employees to cover a broad range of ethical topics, assuming this will indirectly address vendor risk. Option C. Document the high-risk finding in the internal audit report and recommend that the business units manage the risk independently without further compliance department intervention. Option D. Update the compliance manual to reflect the high-risk finding regarding vendor due diligence, but defer any specific control implementation until new regulations are issued in this area. The correct answer is A. Develop and implement a new detailed vendor due diligence policy and procedure, including enhanced screening criteria, ongoing monitoring protocols, and clear escalation paths for identified issues, with assigned responsibilities and a phased implementation timeline. Explanation. This scenario presents a common challenge in compliance and ethics programs, translating a high-level risk assessment into actionable mitigation strategies. The risk matrix, while a valuable tool for prioritization, is inherently a qualitative or semi-quantitative output. The challenge lies in moving beyond simply acknowledging a high-risk area to developing a concrete, effective, and compliant response. Professionals must consider not only the identified risk, but also the specific regulatory landscape, the organization's resources, and the practical feasibility of proposed controls. The correct approach demonstrates best professional practice by focusing on the development of specific, measurable, achievable, relevant, and time-bound, SMART, controls tailored to the identified high-risk area. This aligns with the principles of a robust compliance program, which requires proactive risk management and the implementation of controls that directly address identified vulnerabilities. Regulatory frameworks, such as those governing the Certified Compliance and Ethics Professional CCEP exam, emphasize the need for a risk-based approach, meaning resources and efforts should be directed towards the most significant threats. Developing a detailed action plan with assigned responsibilities and timelines ensures accountability and facilitates effective implementation, thereby demonstrating due diligence and a commitment to mitigating identified risks. An incorrect approach that focuses solely on increasing the frequency of existing, general training without tailoring it to the specific high-risk area fails to address the root cause of the elevated risk. This represents a regulatory and ethical failure because it is an inefficient use of resources and does not demonstrate a genuine effort to mitigate the specific identified vulnerability. It is a superficial response that may not effectively reduce the likelihood or impact of the risk. Another incorrect approach that involves simply documenting the high-risk finding in the compliance manual without any corresponding action plan or control implementation is a significant regulatory and ethical failure. This demonstrates a lack of commitment to proactive risk management and can be interpreted as a failure to implement necessary controls, potentially leading to regulatory sanctions or reputational damage. It is a passive approach that does not fulfill the organization's obligation to manage risks effectively. A third incorrect approach that proposes to wait for a regulatory change before implementing any new controls, despite the current high-risk assessment, is also a critical regulatory and ethical failure. This indicates a reactive rather than proactive stance, which is contrary to the principles of effective compliance and risk management. It exposes the organization to undue risk and potential noncompliance with existing regulations or industry best practices. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the risk. Thoroughly analyze the nature, likelihood, and impact of the identified high-risk area. 2. Identify root causes. Determine the underlying factors contributing to the elevated risk. 3. Brainstorm mitigation strategies. Develop a range of potential controls and actions. 4. Evaluate feasibility and effectiveness. Assess the practicality, cost, and anticipated impact of each strategy. 5. Select and design controls. Choose the most appropriate controls and develop detailed implementation plans, including specific objectives, timeline, and responsible parties. 6. Implement and monitor. Put the controls into practice and establish mechanisms for ongoing monitoring and evaluation of their effectiveness. 7. Review and adapt. Periodically review the risk landscape and the effectiveness of controls, making adjustments as necessary. Question 15. The evaluation methodology shows that a compliance officer is reviewing a request to establish a correspondent banking relationship with a foreign financial institution. The foreign bank is located in a jurisdiction with a moderately high risk profile for money laundering and terrorist financing. The business relationship manager has provided a basic overview of the foreign bank's operations and stated that they have an anti-money laundering AML program in place. What is the most appropriate next step for the compliance officer to take to ensure adherence to U.S. regulatory requirements for correspondent banking due diligence? Option A. Delegate the responsibility for conducting enhanced due diligence to the business relationship manager, trusting their judgment on the foreign bank's compliance posture. Option B. Request detailed information from the foreign bank regarding its AML/CFT policies, procedures, and controls, including evidence of independent testing and the nature of its regulatory oversight, and conduct a risk assessment based on this information and the proposed services. Option C. Accept the business relationship manager's assurance that the foreign bank has an AML program and proceed with onboarding, assuming compliance. Option D. Immediately reject the request for a correspondent banking relationship, citing the foreign jurisdiction's risk profile as sufficient grounds for refusal. The correct answer is B. Request detailed information from the foreign bank regarding its AML/CFT policies, procedures, and controls, including evidence of independent testing and the nature of its regulatory oversight, and conduct a risk assessment based on this information and the proposed services. Explanation. The evaluation methodology shows a critical juncture in correspondent banking due diligence, where a compliance officer must assess the adequacy of controls for a new relationship with a foreign bank. The challenge lies in balancing the need for robust due diligence with the practicalities of international business, ensuring compliance with U.S. regulations, specifically the Bank Secrecy Act, BSA, and its implementing regulations, without imposing undue burdens that could stifle legitimate commerce. The scenario demands a nuanced understanding of risk assessment, the application of the Know Your Customer (KIC) principle, and the appropriate escalation of concerns. The correct approach represents best professional practice because it prioritizes a risk-based assessment that aligns with regulatory expectations. By focusing on the foreign bank's existing AML/CFT program, its regulatory oversight, and the nature of the proposed services, the compliance officer is directly addressing the core concerns of the BSA. This approach demonstrates a commitment to understanding the inherent risks associated with the correspondent relationship and implementing controls commensurate with those risks, thereby fulfilling the institution's regulatory obligations. An incorrect approach that relies solely on the foreign bank's self-attestation without independent verification fails to meet the due diligence standards mandated by the BSA. This oversight creates a significant regulatory and ethical failure by assuming compliance without adequate assurance, potentially exposing the institution to risks of facilitating money laundering or terrorist financing. Another incorrect approach that immediately rejects the relationship based on the foreign jurisdiction alone, without a proper risk assessment, is overly simplistic and may violate principles of fair dealing and proportionality. It fails to acknowledge that risk can be managed and that not all foreign institutions pose an unacceptable risk. A third incorrect approach that delegates the entire due diligence process to the business relationship manager without adequate compliance oversight is a critical failure. This bypasses the essential role of the compliance function in independently assessing risk and ensuring adherence to regulatory requirements, leading to a breakdown in internal controls. Professionals should employ a structured decision-making process that begins with understanding the regulatory landscape, BSA, CEN guidance. This is followed by a thorough risk assessment of the proposed correspondent relationship, considering factors such as the foreign bank's location, its AML/CFT controls, the services to be provided, and the ultimate beneficial owners. The process involves gathering and verifying information, documenting findings, and making a risk-based decision on whether to onboard the client, with appropriate enhanced due diligence if necessary. Escalation to senior management or legal counsel is crucial when significant risks are identified or when there is uncertainty about the appropriate course of action. Question 16. Quality control measures reveal that the organization's current approach to integrating environmental, social, and governance-esque considerations into its operations is fragmented, leading to inefficiencies and potential gaps in reporting. The compliance department is tasked with optimizing this process. Which of the following approaches best aligns with best professional practice for embedding ESG considerations into operational processes? Option A. Conduct a comprehensive review of existing operational processes across all departments to identify key ESG risks and opportunities, and then systematically map these ESG factors onto existing workflows, modifying them where necessary to incorporate ESG objectives and data collection points. Option B. Delegate the entire responsibility for ESG integration to a newly formed sustainability committee, with minimal direct involvement from operational department heads in the process design and implementation. Option C. Prioritize the rapid implementation of a few high-profile ESG initiatives across the organization, without a detailed assessment of their impact on existing operational workflows or data collection capabilities. Option D. Develop a new, standalone ESG reporting system that operates independently of existing operational systems to ensure dedicated focus and specialized data management for ESG metrics. The correct answer is A. Conduct a comprehensive review of existing operational processes across all departments to identify key ESG risks and opportunities, and then systematically map these ESG factors onto existing workflows, modifying them where necessary to incorporate ESG objectives and data collection points. Explanation. This scenario presents a professional challenge because it requires a compliance professional to balance the strategic imperative of integrating ESG considerations into business operations with the practical realities of process optimization. The challenge lies in ensuring that the integration is not merely a superficial exercise, but is embedded in a way that is efficient, effective, and demonstrably contributes to the organization's ESG goals while adhering to relevant regulatory frameworks. Careful judgment is required to avoid creating overly burdensome processes that hinder operational efficiency or, conversely, processes that are so streamlined they fail to capture meaningful ESG data or drive substantive change. The correct approach represents best professional practice because it focuses on a systematic and data-driven methodology for integrating ESG considerations into existing operational processes. This aligns with the principles of good governance and ethical conduct, as it ensures that ESG factors are considered in a structured and accountable manner. By identifying key ESG risks and opportunities within specific business functions, and then mapping these onto existing processes, the organization can leverage its current infrastructure to achieve its ESG objectives. This approach is also more likely to be sustainable in the long term, as it avoids the creation of entirely new, potentially redundant, or disconnected systems. It directly addresses the need for continuous improvement and adaptation, which are core tenets of effective compliance and ethics programs. Furthermore, it supports the development of robust internal controls and reporting mechanisms, crucial for demonstrating compliance with evolving ESG disclosure requirements and stakeholder expectations. An incorrect approach that focuses solely on developing new, standalone ESG reporting systems without integrating them into existing operational workflows would be professionally unacceptable. This failure stems from a lack of process optimization, leading to duplication of effort, potential data inconsistencies, and a disconnect between ESG performance and day-to-day business activities. Ethically, it risks creating a perception of greenwashing if ESG metrics are not genuinely embedded in operational decision-making. From a regulatory perspective, it may lead to incomplete or inaccurate disclosures if the systems are not properly linked to the underlying business activities. Another incorrect approach that prioritizes rapid implementation of ESG initiatives without a thorough assessment of their impact on existing operational processes would also be professionally unacceptable. This haste can lead to the introduction of inefficient workflows, increased operational risks, and a failure to identify and mitigate potential negative ESG consequences of the new initiatives. It demonstrates a lack of due diligence and a disregard for the interconnectedness of business operations and ESG performance, potentially violating ethical duties to act with care and competence. A third incorrect approach that involves delegating ESG integration solely to a dedicated sustainability team, without involving relevant operational departments, would be professionally unacceptable. This siloed approach neglects the critical need for cross-functional collaboration and buy-in. It fails to leverage the expertise within operational departments who are best placed to identify and implement ESG improvements within their specific areas. Ethically, it undermines the principle of shared responsibility for compliance and ethical conduct. Regulationally, it can lead to a lack of ownership and accountability for ESG performance across the organization, potentially resulting in non-compliance with disclosure obligations. The professional decision-making process for similar situations should involve a comprehensive assessment of existing operational processes, identification of key ESG materiality drivers relevant to the organization, and a collaborative approach to integrating ESG considerations into those processes. This requires engaging with relevant stakeholders across different departments, conducting thorough risk and opportunity assessments, and establishing clear metrics and reporting mechanisms that are embedded within the organization's operational framework. The focus should always be on achieving substantive ESG improvements through efficient and effective process integration, rather than creating superficial or disconnected initiatives. Question 17. Governance review demonstrates that a business development manager is pushing to onboard a new client, a holding company incorporated in a high-risk jurisdiction known for money laundering, with the assertion that the client's projected revenue justifies bypassing enhanced due diligence procedures. The compliance officer is concerned that the client's profile presents significant AML/CTF risks. Which of the following approaches best upholds the institution's regulatory obligations under the Bank Secrecy Act, BSA, and the USA Patriot Act? Option A. Implement a cursory EDD review that involves minimal additional checks beyond standard CDD, focusing on documentation rather than substantive risk assessment to satisfy the business unit's request. Option B. Immediately escalate the matter to senior management for a decision without conducting an independent risk assessment or attempting to discuss the regulatory requirements with the business development manager. Option C. Insist on conducting full enhanced due diligence procedures commensurate with the identified risks, including beneficial ownership verification and source of funds investigation, before onboarding, and clearly communicate the regulatory rationale to the business development manager. Option D. Accept the business development manager's assurance that the client's revenue potential outweighs the risks and proceed with standard customer due diligence, CDD, without further investigation. The correct answer is C. Insist on conducting full enhanced due diligence procedures commensurate with the identified risks, including beneficial ownership verification and source of funds investigation, before onboarding, and clearly communicate the regulatory rationale to the business development manager. Explanation. Scenario analysis. This scenario presents a common challenge in AML/CTF compliance where a business unit, driven by revenue targets, pushes back against enhanced due diligence requirements. The compliance officer must balance the need to facilitate legitimate business while upholding regulatory obligations to prevent financial crime. The challenge lies in interpreting and applying the risk-based approach mandated by regulations, ensuring that EDD is applied appropriately without unduly hindering business operations. This requires a deep understanding of the specific risks associated with the customer and the regulatory expectations for EDD. Correct approach analysis. The correct approach demonstrates best professional practice by prioritizing regulatory compliance and a robust risk assessment. It acknowledges the inherent risks associated with the customer's geographic location and business activities, which are key indicators for enhanced due diligence under the Bank Secrecy Act, BSA, and the USA Patriot Act. By insisting on EDD, the compliance officer is adhering to the risk-based approach, which requires more stringent measures for high-risk customers. This proactive stance prevents potential regulatory penalties, reputational damage, and the facilitation of illicit activities. It also aligns with the ethical duty of a compliance professional to safeguard the integrity of the financial system. Incorrect approaches analysis. One incorrect approach fails by accepting the business unit's assertion without independent verification. This bypasses the core principle of the risk-based approach, which necessitates a thorough assessment of customer risk by the compliance function, not solely by the business unit. This failure could lead to onboarding a high-risk customer without adequate controls, violating the BSA and USA Patriot Act's requirements for customer due diligence, and potentially exposing the institution to significant financial crime risks and regulatory sanction. Another incorrect approach is to implement a superficial EDD process that merely goes through the motions without substantive risk mitigation. This approach, while appearing to comply, is a form of regulatory arbitrage and does not fulfill the spirit or intent of the law. Regulators expect EDD to be meaningful and proportionate to the identified risks. A superficial EDD process would be deemed non-compliant under the BSA and USA Patriot Act, leading to potential enforcement actions. A further incorrect approach is to escalate the matter without attempting to resolve it through a risk-based discussion. While escalation is sometimes necessary, a compliance officer's primary role involves assessing risk and applying appropriate controls. Immediately escalating without a proper risk assessment and discussion with the business unit demonstrates a lack of proactive risk management and an abdication of responsibility. This could be seen as a failure to effectively implement the institution's AML program, which is a requirement under the BSA. Professional reasoning. Professionals should approach such situations by first understanding the specific regulatory requirements for EDD based on customer risk factors e.g., geographic location, business type, transaction patterns. They should then conduct an independent risk assessment of the customer, documenting the rationale for any EDD measures. Engaging in a collaborative discussion with the business unit, explaining the regulatory basis for EDD and the identified risks, is crucial. If consensus cannot be reached, a formal escalation process to senior management or a dedicated risk committee should be initiated, presenting a clear risk assessment and proposed mitigation strategies. Question 18. Strategic planning requires a compliance officer to assess how a financial services firm can ethically and legally leverage market intelligence gathered from various business units, including investment banking and research, while simultaneously preventing the misuse of material non-public information, MNPI, and potential insider trading. The firm's leadership is keen to capitalize on insights that could inform proprietary trading strategies. What is the most robust and compliant approach to manage this inherent conflict? Option A. Implement a policy that broadly restricts all employees from trading in any securities related to the firm's investment banking activities, without specific definitions or a pre-clearance process. Option B. Establish a comprehensive information barrier, clearly define restricted persons who have access to MNPI, and implement a mandatory pre-clearance process for all trades by these individuals, with rigorous monitoring and record-keeping. Option C. Focus on the potential profitability of proprietary trading strategies, assuming that any insights gained are purely analytical and not MNPI, and address potential issues only if a regulatory inquiry arises. Option D. Rely on employees' general understanding of insider trading laws and their personal assurances that they will not trade on MNPI, assuming they will act responsibly. The correct answer is B. Establish a comprehensive information barrier, clearly define restricted persons who have access to MNPI, and implement a mandatory pre-clearance process for all trades by these individuals, with rigorous monitoring and record-keeping. Explanation. This scenario presents a professional challenge because it requires a compliance officer to balance the firm's business objectives with stringent regulatory requirements, specifically concerning the handling of material non-public information, MNPI, and potential insider trading. The firm's desire to leverage market intelligence for strategic advantage must be carefully managed to avoid any appearance or reality of illegal trading activities. The compliance officer must demonstrate a deep understanding of SEC rules and FINRA regulations, governing information barriers and trading restrictions. The correct approach represents best professional practice because it prioritizes the integrity of the securities markets and the firm's adherence to the law. By implementing a robust information barrier, clearly defining restricted persons, and establishing a pre-clearance process for all trades by designated individuals, the firm actively mitigates the risk of MNPI misuse. This proactive stance aligns with the spirit and letter of SEC Rule 10b-5 and FINRA Rule 2010, which prohibit fraud and manipulation in securities transactions and require members to uphold high standards of commercial honor and just and equitable principles of trade, respectively. This approach demonstrates a commitment to ethical conduct and regulatory compliance, safeguarding both the firm and its clients. An incorrect approach that focuses solely on the potential for profit without implementing adequate controls would represent a significant regulatory and ethical failure. This would violate SEC Rule 10b-5 by creating an environment where insider trading could occur, leading to market manipulation and unfair advantages. Ethically, it demonstrates a disregard for fair markets and investor protection. Another incorrect approach that relies on informal assurances from employees about their trading activities is also professionally unacceptable. This lacks the necessary documentation and oversight required by regulatory bodies. It fails to establish a clear, enforceable policy and creates a high risk of inadvertent or intentional violations, as informal understandings are not a substitute for formal compliance procedures. This approach would likely be viewed by regulators as a failure to establish and maintain effective supervisory procedures, a violation of FINRA Rule 3110. A third incorrect approach that assumes all employees are aware of MNPI and therefore subject to trading restrictions without clear definition or communication, also problematic. While all employees have a general duty of confidentiality, specific trading restrictions, and the definition of restricted persons need to be clearly articulated and communicated. This ambiguity increases the likelihood of unintentional violations and demonstrates a lack of proactive compliance management. The professional decision-making process for similar situations should involve a thorough risk assessment, a deep understanding of applicable regulations, SEC and FINRA in this case, and the development of clear, documented policies and procedures. This includes identifying potential sources of MNPI, defining who has access to it, establishing strict information barriers, and implementing robust monitoring and enforcement mechanisms. Regular training and communication with employees are crucial to ensure understanding and compliance. When in doubt, erring on the side of caution and seeking legal or compliance counsel is always the most prudent course of action. Question 19. Cost-benefit analysis shows that significantly reducing the scope and frequency of independent testing for the anti-money laundering (AML) program could yield substantial immediate cost savings. However, the institution's most recent risk assessment identified moderate to high risks in several key transaction monitoring areas. Given these findings, which approach best aligns with the regulatory framework for an effective AML program? Option A. Implement the proposed reduction in independent testing to achieve immediate cost savings, relying on the effectiveness of automated systems to mitigate risks. Option B. Reduce the frequency of independent testing to an annual basis across all areas, regardless of the risk assessment findings, to standardize cost savings. Option C. Maintain the current level of independent testing, adjusting its scope and focus based on the risk assessment, even if it means reallocating funds from less critical areas or seeking additional budget. Option D. Delegate the independent testing function to an external vendor that offers a significantly lower cost, without a thorough review of their methodology or expertise. The correct answer is C. Maintain the current level of independent testing, adjusting its scope and focus based on the risk assessment, even if it means reallocating funds from less critical areas or seeking additional budget. Explanation. This scenario presents a common challenge in compliance, balancing resource allocation with regulatory mandates. The core difficulty lies in determining the appropriate level of investment in an anti-money laundering AML program component when faced with competing priorities and limited budgets. A cost-benefit analysis, while useful, must not override the fundamental requirements of a robust AML program as defined by the relevant regulatory framework. The challenge is to identify the approach that best satisfies both operational efficiency and regulatory compliance, ensuring the program remains effective in mitigating money laundering risks. The correct approach prioritizes the integrity and effectiveness of the AML program by ensuring that all mandated components are adequately resourced and implemented, even if it means a higher initial cost. This aligns with the principle that compliance is not merely a cost center but a critical function for protecting the institution and the financial system. Regulatory guidance, such as that from FinCEN, Financial Crimes Enforcement Network, in the U.S., emphasizes that an effective AML program must be comprehensive and tailored to the institution's specific risks. This includes robust policies, procedures, ongoing training, and independent testing. Investing in these areas, even if the immediate cost-benefit analysis appears unfavorable, is essential for meeting these regulatory expectations and avoiding significant penalties and reputational damage in the long run. An incorrect approach would be to disproportionately cut funding or reduce the scope of a critical AML program component based solely on a short-term cost-benefit calculation that overlooks the inherent risks and regulatory obligations. For instance, reducing the frequency or depth of independent testing to save money, despite the risk assessment indicating a moderate to high risk in certain areas, would be a significant regulatory failure. This demonstrates a lack of commitment to the core principles of AML compliance and a failure to adequately address identified risks. Similarly, neglecting comprehensive, risk-based training for employees or allowing policies and procedures to become outdated due to cost constraints would violate the expectation that the AML program is dynamic and responsive to evolving threats. These actions could lead to ineffective detection and reporting of suspicious activity, thereby exposing the institution to significant legal and financial repercussions. The professional decision-making process in such situations requires a thorough understanding of the regulatory framework, a comprehensive risk assessment, and a clear articulation of the potential consequences of under-resourcing critical compliance functions. Compliance professionals must advocate for adequate resources by framing AML as a strategic imperative, not just an operational expense. This involves demonstrating how a well-funded and effective AML program protects the institution from financial crime, regulatory sanctions, and reputational harm, ultimately contributing to long-term business sustainability. When faced with budget constraints, the focus should be on optimizing existing resources and seeking efficiencies within the mandated components, rather than compromising their fundamental effectiveness. Question 20. The control framework reveals that a compliance officer is responsible for overseeing the vendor selection process for a new client relationship management system. During the evaluation, the compliance officer discovers that one of the leading vendor candidates is a company in which their spouse holds a significant, undisclosed personal investment. The compliance officer has not previously disclosed this spousal investment to their employer. What is the most appropriate course of action for the compliance officer? Option A. Discreetly advocate for the vendor in which their spouse has an investment, highlighting its strengths to influence the selection committee without explicitly mentioning the personal connection. Option B. Proceed with the vendor selection process, ensuring the chosen vendor is objectively the best fit for the company's needs, and consider disclosing the investment later if the vendor is selected. Option C. Immediately disclose the spousal investment to their direct supervisor and the head of procurement, and recuse themselves from all further involvement in the vendor selection process for the CRM system. Option D. Resign from their position to avoid any appearance of impropriety or conflict of interest in the vendor selection process. The correct answer is C. Immediately disclose the spousal investment to their direct supervisor and the head of procurement, and recuse themselves from all further involvement in the vendor selection process for the CRM system. Explanation. This scenario is professionally challenging because it involves a direct conflict between a personal financial interest and the duty to act in the best interest of the employer and its clients. The compliance professional must navigate this situation with utmost integrity, ensuring that personal gain does not compromise professional responsibilities or violate regulatory expectations. The core challenge lies in identifying and managing the conflict transparently and effectively, adhering strictly to the established control framework and relevant regulations. The correct approach represents best professional practice because it prioritizes transparency, adherence to policy, and objective assessment by immediately disclosing the potential conflict to the appropriate authority and recusing oneself from any decision-making process related to the vendor. The compliance professional upholds their fiduciary duty. This aligns with regulatory expectations that require individuals to avoid situations where personal interests could improperly influence professional judgment. It demonstrates a commitment to ethical conduct and the integrity of the compliance function, preventing even the appearance of impropriety. An incorrect approach that involves proceeding with the vendor selection without disclosure fails to address the conflict of interest, thereby violating ethical principles and potentially regulatory requirements. This creates a significant risk of biased decision-making, where the personal financial gain could unduly influence the selection process, leading to suboptimal outcomes for the employer and potentially harming clients. Another incorrect approach, such as attempting to subtly influence the decision in favor of the vendor without explicit disclosure, is even more egregious. This constitutes a deliberate attempt to mislead and manipulate the process for personal benefit, representing a severe breach of trust and a direct violation of ethical standards and likely regulatory prohibitions against deceptive practices. A further incorrect approach, such as resigning from the company to avoid the conflict, might seem like an avoidance tactic, but fails to address the immediate ethical obligation to manage the conflict responsibly while still employed. Professional decision-making in such situations requires a proactive and transparent approach. The framework for professional reasoning involves 1. Recognizing the potential conflict. 2. Understanding the relevant policies and regulations. 3. Disclosing the conflict to the designated authority. 4. Recusing oneself from any decision-making or influence related to the conflict. And 5. Cooperating with any review or investigation. This systematic process ensures that conflicts of interest are managed ethically and in compliance with all applicable standards.